Hello everyone, I'm back. I'm so glad to be back. In fact, I was watching the stock market when I was on my flight back to Singapore. Anyway, the US stock market had a sell-off last Friday as Wall Street digested the latest jobs report and fears about higher inflation. Shares of big tech companies slumped last week with Tesla, Amazon, Apple, Microsoft and Alphabet all declined. As a result, both S&P 500 and Nasdaq registered their second consecutive week of losses. But here's something interesting. For the last 2 weeks, we had two major dips in the market caused by DeepSeek and Trump's tariffs, but the market recovered almost fully in just 4 to 5 days. The market seems to be trained to buy every dip so far. So with the latest sell-off, will the buy the dip crowd step in again? While I can't be sure about that, I myself had stepped in last 2 weeks to buy shares of two companies. I will share it at the end of the video, so do watch on to find out more. Okay, it has been a wild and volatile week. US stocks fell last Monday after President Donald Trump announced tariffs on Canada, Mexico and China over the last weekend. Later on, he then paused the 25% tariff that is to be imposed on Canada and Mexico, which then caused the stock market to gain for 3 straight days. But then on Friday, the stock market fell again as Trump said he will announce reciprocal tariffs on many countries in this coming week. This came on top of a refreshed inflation worries by the US consumers. According to University of Michigan, the latest consumer sentiment fell in February to 67.8, which is below the expectation of 71.3. In addition, the respondents anticipate the one-year inflation rate to hit 4.3%, up from the earlier reading of 3.3%. This is the highest level since November 2023. This kind of indicates that consumers are becoming increasingly concerned that Trump's tariff policies could refuel inflation and dampen broader economic activities. Adding to the inflation worries, the latest January's jobs report showed that the average hourly earnings jumped by 0.5%, higher than the 0.3% expectations. To explain in layman terms, strong wage growth can cause inflation because it increases the cost of producing goods and services. This then leads to companies raising prices to maintain profitability. On the earnings front, Amazon's cloud units, AWS, fell short of market expectation, joining its Wall Street counterparts such as Microsoft and Google in reporting weak cloud growth. This has raised some questions about the returns on investments from AI, especially as these mega-cap tech companies have announced so many plans of ramping up their AI-related capex in 2025. On a side note, Tesla shares posted its worst week since October last year, falling by roughly 11% for the week. This was caused by a plunge in their sales from all around the world, such as Germany, France, UK and China. With the shares of so many big tech companies falling last week, it's no surprise to see the major indexes close out last week in the red territory. Moving over to the upcoming week, the market volatility will almost certainly continue as Trump is set to announce a series of reciprocal tariffs on many countries. While it wasn't clear which countries would be targeted, the news had definitely caused some fresh fears about a brewing global trade war. Investors will also get the January CPI and PPI inflation reports on Wednesday and Thursday respectively. This will be a fresh test for the US stock market as investors worry that President Trump's tariff plans, which are widely seen as inflationary, could potentially endanger Wall Street's hopes for interest rate cuts this year. Okay, in terms of companies' earnings results, notable retail investors' favorites that are reporting this week include Shopify, Coinbase, Palo Alto, Reddit, and Supermicro Computer. Okay, let's now move on to the technical analysis section. Something interesting to share on SPY chart. The stock market saw a sell-off for 3 consecutive Fridays caused by DeepSeek and Trump's tariffs plan. Interestingly, for the first 2 sell-offs, the market continued to decline on the following Monday before recovering by the end of the week. So, will the market do it again this coming week? Well, it's difficult to predict, but let's keep an eye on some of the key support and resistance levels. At the moment, the trend of the broader market is towards the bearish side. Why so? First of all, it has created lower highs and lower lows over the past 3 weeks. This is the basics of price movement. Secondly, the MACD is about to cross down, but it hasn't happened yet. So come this week, watch it closely. If the MACD has a bearish cross, I wouldn't be surprised if SPY falls towards the 50% Fibonacci level at 593. This is one potential level to bounce. Okay, but if it doesn't bounce up here and goes lower than last week's low at 590, then the bearish trend is confirmed to be continued. The best will then likely bring SPY below the critical 61.8 Fibonacci level at 589 to the gap area. This gap area is between 585 to 589. It should act as a decent support. If SPY ever gets to this gap area, I will have my shopping list ready and to see if I can pick up some shares at discounted price. Okay, on the other hand, if somehow the market decides to bounce back up, the bulls would want to see SPY going above last week's high at 608. By doing so, it helps to stop the bearish price action of lower highs. To add on to this, it would be more bullish if SPY can close above this 608 level instead of touching it during intraday only. But of course, for a complete reversal in this short-term bearish trend, SPY needs to take out the recent high of 610. That will then give us a high probability of creating another new record high. Moving over to Apple. Apple looks weak to me for a couple of reasons. First of all, it went above the important level of 237 and the 50 moving average, but it couldn't sustain and fell back down. Secondly, it has been testing the 100 moving average for the entire of last week and couldn't get above it. Thirdly, just like SPY, the MACD is about to have a bearish cross. Watch it closely this week. If it crosses down, I do think there is a high probability for the 200 moving average to be tested at around 221. At this level, I might give and take a little and stretch it to 219 in terms of the support level. Apple touched this 219 level twice recently in November and January. Each time, the share price rebounded. So yeah, hope you get that. 219 to 221 should present a decent support area. In case you're not aware, Apple has not breached the 200 moving average since May 2024. So the bulls have to protect this area at all costs. Otherwise, if this area gets breached, it's very bearish and it's waterfall time. On the other hand, if Apple bounces off the support area, it is still not out of the woods yet. For Apple to reverse this recent bearish trend, it needs to reclaim the two important levels that I mentioned earlier on. They are 237 and the 50 moving average at around 240. 240 is also where the potential reversal 0.50% Fibonacci level is. Therefore, anything below 237 to 240, Apple is still bearish in my opinion. Let's now have a look at Tesla's chart. Well, it has been a rough few weeks for Tesla's share price. Last week alone, Tesla fell about 11%, and from the recent high of 488 to the recent low of 360, that's a 26% plunge. If you have been following my channel, you wouldn't be surprised because I have mentioned on a few occasions that once 380 support area gets breached, I am expecting the share price to go to 350's range. And that really happened as Tesla touched 357 during last Friday's post-trading hours. If the sell-off continues this week, pay special attention to the 50% Fibonacci retracement level at 350. This is one potential bounce level. Okay, here's something to note. Even if it bounces off 350, don't be too happy yet. As you can see on the screen, I have drawn this zigzag pattern. Tesla is clearly on a downtrend, so a bounce doesn't mean anything because it could bounce and go back down again. If somehow 350 gets breached, I'm not kidding you, the share price might grind towards 330s or 320s range, where that mini consolidation zone is. So will I add more shares at this area? Okay, before I answer that question, give me 30 seconds. If you would like to support this channel and are looking for a new brokerage account, do consider signing up a Longbridge account using my referral link. Deposit 2,000 Singapore dollars, maintain the fund for 30 days, make 3 separate buy trades, and you will get a free Nvidia share. There's also additional $18 cash coupon for you if you sign up using my link. Okay, that's about 23 seconds. Alright, back to the question, will I add more Tesla shares at 330s or 320s range? I mean, for Tesla to fall from 488 to 330, that's more than 30% decline, and I should bargain hunt, right? Well, not quite so for me. Long-term viewers would know that my portfolio is heavy on Tesla and I have enough allocation. The area that I might consider adding some shares at this point would be that green box that I have drawn at around 260s to low 270s range. I don't know if Tesla will come to this area again, so let's see. Alright, on the other hand, for Tesla to stop its rot, it needs to fill that gap and reclaim the 50 moving average, which means to close above 402. But that's only the first baby step to reverse the bearish trend. Tesla bulls would want to see the share price going above the recent high of 440. By doing so, it could potentially invalidate the lower highs price action as well as invalidate the zigzag downtrend pattern. Okay, moving over to Google. I don't think I need to tell you the obvious that the chart looks bearish. I mean, look at how the share price gapped down after the company reported its earnings. It basically sliced through the various Fibonacci retracement levels like a tofu, and even went below the critical 61.8 Fibonacci level. On top of that, it also lost the 50 moving average and the blue support line that I drew, sitting at around 188. At this point, I'm not banking on Google reversing the bearish trend yet. It could well continue to decline towards 181. This level is quite important because it used to be a level of resistance but has now turned into a support. It is also the level where Google gapped up previously. If buyers don't step in here, then be mentally prepared for Google to fill that huge gap between 176 to 181. At this area, the support zone to watch would be 174 to 176, formed by the bottom of the gap, the 200 moving average, as well as the 123.6 Fibonacci retracement level. This area is unlikely to be breached in the next 2 weeks, unless the whole market, for whichever reason, is very bearish. On the other hand, for Google to reverse the current downtrend, it does have a lot of work to do. First and foremost, or rather, it's pretty important for Google to at least reclaim the blue line at around 188, as well as the 50 moving average, which is about 190. A close above this area would give the bull some positivity. From there, the share price could slowly grind up to fill that huge gap down. Honestly, I think it's quite an uphill task without solid catalysts. Okay, let's now have a look at Meta's chart. Meta is the classic example of what I have always shared, which is at all-time high, sellers usually dry up, and the share price will tend to go up further and further. And at all-time highs, it's very difficult to predict when will market makers start to dump the shares and cause the price to fall again. The chart also shows a classic example of a breakout after a consolidation phase. In case you don't know, typically after a consolidation period, there tends to be a huge movement which could be up or down. In this case, it went up. And if one was able to combine both theories and traded the upside the moment it broke out, the trade will be in huge profit. Anyway, though we don't know when will market makers start to take profits, we can try to look at possible resistance levels. As you can see on the screen, the share price hit the 161.8 Fibonacci extension level at around 725 and got rejected. So if the bullish momentum were to continue this week, I would expect this 725 level to act as a resistance again. And if somehow Meta can get above 725, I kid you not, the next meaningful resistance is at around 759. Again, I must emphasize that at such uncharted territory, market makers can take profits anytime they want. So it doesn't mean that above 725, Meta will definitely head towards 759, alright? In terms of the bearish thesis, a word of caution is that the RSI is at the overbought level. The last time when Meta's RSI was at this level, we had a sell-off that lasted for about a month. Not saying it will happen this time because it's all about probability. To put it simply, the probability of a pullback below 700 is higher than the share price going above 725. I could be wrong. If Meta does pull back, don't blink your eyes, because in the blink of an eye, Meta could be at 650's range again. That's a 60-point drop from the current level. But of course, this will not happen in 1 or 2 days. It may take days or weeks to pan out, let's see. Moving over to Microsoft's chart. Similar to Google, I don't think you need me to mention that the chart looks bearish. I mean, look at the huge post-earnings gap down. As it gapped down, it lost the 50, 100 and 200 moving averages all at one go. If the bearish momentum continues this week, there are a few key support levels to watch. The first level is 400, which is a psychological support level, but I might stretch it a little bit to the second level to watch, which is that green support line that I drew at around 395. And then the third level to watch, which is also the last line of defense, is around 385. The share price came to this level twice in the last 1 year and somehow managed to rebound. So I would say this is a demand area where buyers tend to snap up some Microsoft shares. Not financial advice, but I personally do think that those support levels are decent levels for me to pick up more Microsoft shares for my long-term portfolio. Alright, in terms of the upside, straightforward. Fill that huge gap, which I know it's an uphill task, so perhaps at the very least, reclaim the 3 key moving averages. By doing so, it could potentially stop the rot for Microsoft. Moving over to Nvidia. Nvidia's chart looks a little tricky for traders to trade. It's so volatile and was giving mixed signals. As you can see, it previously broke out of that red downtrend channel and went to create a new all-time high. That's bullish. But shortly after, we had a huge gap down because of the news on DeepSeek, where the share price plunged about 17% and went back into the downtrend channel, and that's bearish. But then, next moment, the chart printed 5 straight green candles, reclaimed the important 200 moving average and went above the downtrend channel again, and that's bullish. So what's next? Well, nobody can accurately predict its next movement. In terms of the upside, I think we can watch the gap closely, which is between 130 and 141. It seems like Nvidia is on its way to fill the gap, as it has filled a little bit last week. Some key resistance within the gaps are the 50 moving average at 135 as well as the 61.8 Fibonacci level at 138. If Nvidia can get past these levels, I think we could see high 140s range soon. And if it can break the recent high of 149, that's very bullish, and I wouldn't be surprised if it continues to grind even higher towards the all-time high at 153. One potential good news for the bulls is that the MACD is about to have a bullish cross. If it happens this week, I think we could see 135 at least. Alright, as for the downside, watch that 200 moving average like a hawk. If Nvidia loses this level, it means it's back into this downtrend channel, and that is obviously bearish. When that happens, expect Nvidia to test 113 again, or perhaps even go below it. Okay, moving over to the options trading section. In my recent video about my YouTube journey, I have requested some feedback on whether this section is still useful. Appreciate those who offered your suggestions. So one of the suggestions was to do a separate video for this segment. I gave it a thought but have decided to still keep within this video because having a separate video means I have to do a different thumbnail, do a separate editing, as well as write new description and timestamps, etc. That being said, I've incorporated another suggestion by a viewer, which is to have a summary of my trades. And here you go, I have made quite a few trades over the last 2 weeks as the market was very volatile, which is a good thing for options seller like me. Anyway, there was one more suggestion which I am considering as well, which is to produce videos on the technical indicators or patterns that I usually used. Alright, let's now quickly cover my options trades. I will cover these 3 Nvidia trades at one go as the thought process were the same. Basically, I sold 2 cash secure puts on 27 January Monday with 2 different strike prices, 95 and 100. The contracts will expire on 28 February and 7 March respectively. Just to refresh our memories, on 27 January, a Chinese AI company called DeepSeek caused a significant drop in Nvidia's stock price, with the company losing nearly $600 billion in its market cap. According to Bloomberg, this is the deepest single-day loss for a company in Wall Street. The concerns were that DeepSeek's advanced cost-effective AI model could threaten Nvidia's dominance in the AI chip market. With such a massive drop in the share price, I stepped in to sell 2 put contracts right immediately, which is a slightly bullish move, for one main reason that starts with O. For long-time viewers of this channel, would you be able to guess this word? If yes, please comment down below. And then on Thursday 30th January, I continued to double down on my position by selling another put option on Nvidia with a strike price of $95 expiring 7 March. This just shows how confident I was that Nvidia will likely have a short-term bounce. Well, true enough, Nvidia bounced back up last week as it printed 5 straight consecutive green candles, and all 3 trades are sitting on paper gains now. I can take profits if I want. Next up is this new cash secure put on Microsoft. So on 30th January, Thursday, the strike price is $385 and the contract will expire on 7 March. What happened on 30th January was that the market was selling off Microsoft shares after it reported its earnings a day earlier. But were their earnings that bad? Nope, they weren't. In my opinion, overall their results were pretty decent as it beat estimates on the both top and bottom lines. But investors are disappointed as the company reported slower than expected growth in their cloud business and the next quarterly revenue forecast. As a result, the share price fell more than 6% on 30th January. Once again, I stepped in for the same reason that starts with O. But unlike Nvidia, the stock did not bounce immediately as it continued to trend lower for the next few days. Despite that, the trade is up a little bit right now due to time decay and a drop in implied volatility. Okay, the third trade to update is this new cash secure put on Tesla. So on 31st January, Friday, the strike price is $315 and the contract will expire on 14 March. Okay, just to be transparent and not to hide any trades, this position is currently sitting on a paper loss of 93%. Reason being, when the market opened the following Monday 3rd February, the whole market was on a sell-off mode, and unfortunately, Tesla was the worst performing Magnificent 7 stock on that day, falling more than 5%. The weakness in the market came after President Trump announced plans to impose tariffs on Canada and Mexico. So given that the trade is down almost 100%, should I panic? No, I don't have to. In the past, I have seen how my trades can swing from negative 200 to 300% to positive 100%. Furthermore, I believe there are a few decent support levels above my 315 strike price, namely the 61.8 and 50% Fibonacci levels, as well as the 100 moving average. Therefore, I will just let this trade run and see how it goes nearer to expiration date. The fourth new position that I opened when I was away is this new cash secure put on Google, so on 5th February, Wednesday. The strike price is $175 and the contract will expire on 21st March. What happened on 5th February for Google was pretty similar to Microsoft. The company reported decent earnings, at least in my opinion, but the Google Cloud revenue fell short of expectations. As a result, the share price dropped as low as 9% at one point and closed the day down about 7%. This is its largest percentage decrease since October 2023. And once again, it's the same reason for selling this bullish put option. So viewers who know that reason that starts with O, do comment down below, alright? So that others will know. But if no one comments below, feel free to ask if you're unsure. Anyway, the reason for selecting 175 as the strike price is because there are a few decent support levels above it, which are the 61.8 Fibonacci level, 50 moving average, the blue support line, 100% Fibonacci retracement level, the bottom of the gap, as well as 200 moving average. That's 6 support levels in total. Unfortunately, Google has breached 3 out of the 6 support levels, which explains why the trade is currently sitting on a paper loss of about 24%. Again, there's no need to panic yet because we have 3 more support levels to go. Let's see how the trade pans out. I will be updating this trade again, so do stay subscribed to my channel if you haven't. Alright, the final 2 trades to update are these 2 contracts on Tesla and Microsoft that expire on 31st January and 7th February respectively. Both contracts were sold on 3rd January. I will not elaborate the thought process here as this segment is getting too long. So if you are interested, you can check out the video linked at the top. Just like every trade that I made for the options wheel strategy, I shared them transparently in that video. Anyway, both trades expired worthless because the share prices closed above my strike prices on their expiration dates. The total profits for these two trades is about $420 US. That's more than 550 Singapore dollars, covering some of my overseas shopping expenses. Okay, let's share some of my thoughts of the market as we are about 3 to 4 weeks into the new Trump administration. As you can see, the stock market is very choppy, volatile, and very headline driven. There has been a wild streak of sessions that whipsaw on trade uncertainty, big tech earnings, and economic data. It's probably one of the most challenging environments for investors as compared to the last 12 months, especially for short-term investors and traders. It's like on a certain day there's enough strength in the market to lure traders in, but shortly after there's enough weakness to shake them out. Therefore, I would think it's best for new traders or short-term investors to stay out of the market during this period. There's nothing wrong to do nothing in times like this, especially if your risk tolerance isn't that high or if you're not seasoned enough in the stock market. As for long-term investors, it helps to remind yourself to have or maintain a longer-term perspective. In this environment, to avoid getting affected or influenced by the daily wild swings and price movements, one can consider using weekly charts to put the major indexes and individual stocks in perspective. But if you still prefer to look at daily charts, feel free to use my technical analysis as a reference, though I must say they are not financial advice, okay? Personally, for me, I use daily charts to set my entry points, and on that, just to share, I have stepped in for Microsoft and Google while I was away for the last 2 weeks. For both companies, I bought the post-earnings dips as I am of the view that their fundamentals are still very strong, and the market was overreacting to their weak growth in their cloud services. It's like both companies have scored 90 points in their exams, but the Wall Street wants 98 points. So the question is 90 points good enough? It may not be for the Wall Street, but it's good enough for me, and hence I step in. But of course, this is not a buy recommendation to my viewers. Please do your own due diligence, alright? And oh, just to add, I have only stepped in a tiny bit as my plan is to be incremental in my purchases. I tend to buy in tranches instead of going all in or make huge purchases. Alright, all in all, the US stock market will likely stay shaky and choppy in the near term, not only because of uncertainty about earnings, interest rates and inflation, but also about Trump's tariffs and other unknowns all around the world. So do stay engaged with the tariff and inflation news and stay nimble in your investment decisions. Once again, if the short-term volatility is affecting you even as a long-term investor, stay out during this period to avoid making emotional or impulse decisions. More importantly, stay subscribed to my channel for weekly market updates and technical analysis. Don't forget to give this video a thumbs up if you like my content. Thank you very much.